Good morning. This is Deborah Smith and Raina Nara from the Ohio Department of Taxation. We're glad everyone could join us. We're going to spend the next 90 minutes trying to share some information on the Ohio 50% Small Business Investor Income Deduction. Just a little bit of housekeeping here at the beginning. I know some of you have asked if there are handouts available or if the PowerPoint is posted anywhere, and it was not prior to this presentation. We will be posting it in a couple of locations on our website. We'll be posting it on the Ohio Virtual Tax Academy webpage portion of our website. Also from our home page, in the center of the home page, there is a link to the 50% small business investor deduction. So you'll be able to reach it from there as well. And our intent would be to have it out there by about next Wednesday. And that will be the actual live presentation, complete with audio on that. We can also post a version that is just the PowerPoint if you want to print it out. Apologize for not having it available prior to the session, but we were actually working on this still well through the evening last night. It came up from a presentation that we did about a week and a half ago at the Virtual Tax Academy, and we've been striving to try to make sure we're covering the most commonly asked questions and provide scenarios for that. Additionally, we will be sending a tax alert out next week to several other people that are signed up for personal income tax alerts, letting them know where they can find this on our website. And then lastly, before we begin, we're going to ask that you go ahead and chat your questions in as you would choose to throughout the session, and then we'll go back and respond. We're hoping that some responses may be provided during the session. We have a person on here, Vaughn Lombardo, is joining us from a chat perspective, and he might be able to answer some of your questions as we're going through. If we do not get through your questions, we're going to take those and post responses to our website as well. We have about almost 100 questions that came out of the Virtual Tax Academy webinar that we did a couple of weeks ago, and we're posting those to the Virtual Tax Academy webpage next Friday. So you may find that some of the questions you're asking today are also questions that we received there. So we're trying to keep everything updated as soon as we can. So I'm going to go ahead and start the webinar today, and I say I will if my slide's going to advance. There we go. So I'll cover the first several slides, and then Raina will join in if she has any input on these, and she'll pick up in the middle of a section, and we'll just kind of go back and forth as we get through the information. So to start off, this new 50% small business investor income deduction is effective for tax year 2013 and forward, and it's for 50% of your small business investor income up to a maximum of $250,000 in income. It is taken on the Ohio Schedule 1040A, and there are some maximum thresholds. If you are married filing separately, then your cap for that deduction line is $62,500. For all other taxpayers, the maximum income subject is $125,000. And one of the things that we'd like to note out of this is favorable to business owners who didn't benefit from the elimination of the Ohio corporate franchise tax. We're going to talk a little bit more about this later and provide some examples, but one of the key things to note is that the income that is subject to this is the portion of a taxpayer's income that is business income reduced by business deductions and apportioned to Ohio. So it's the portion of that taxpayer's AGI. This does include net business income from pass-through entities and sole proprietorships that are operating in Ohio, and you can most likely find that income included on your federal Form 1040 from Schedule C, E, and F from the respective lines that we've indicated here. This is just a quick view of what the IT SBD form looks like. This is our, it does accompany the Ohio IT 1040, and the line you carry over from this small business schedule to line 41 if you're looking at a paper 1040. One thing to note is this small business deduction is not available if you file via telefile or if you use a 1040 EZ. You must complete the 1040, whether electronic or paper, but you must complete the Form IT 1040A to be eligible for the small business deduction. You can find forms and schedules and everything, instructions on our website at tax.ohio.gov, forms. So this IT SBD, is it required to be filed electronically? This is one of the questions that we've received, and we have subsequently posted this to some FAQs. If your software allows for the attachment of a PDF document when you're submitting it electronically, or if your preparer software, then they would attach a copy of the IT SBD as a PDF document and submit it all electronically. If your software does not allow for PDF attachments, you would just keep a copy of the IT SBD for your records should it be requested upon review of the tax return here by the department. If you're filing a paper 1040 return, you would go ahead and just attach that IT SBD schedule to that paper filing. I mentioned just a second ago, we do have a frequently asked questions area available on our website specifically for the 50% small business deduction. From our home page of our website, at the bottom of that page, there's an icon toward the bottom left that is FAQs. If you simply clicked on that, it would come up and bring you drop-down choices here to choose what topic you would like to see frequently asked questions. And this would be under Income Small Business Investor Deduction. I think currently we have about maybe 22, 23 frequently asked questions there as well right now. We are continually updating materials, both the FAQs that I spoke of and the instructions for the IT SBD. We have formed a subject matter expert call-in line. We have 4 individuals on that line every day taking calls, also responding to emails that come in. As I say, subject matter experts, they've been getting trained on this and kind of by direct fire as we've had this new on the tax return this year. They are becoming quite experienced in the questions that are calling in, but if they cannot respond to your question at the time, they are great about taking messages and referring those up to Raina or myself or Von Lombardo and trying to get back with everybody within a 24 to 48 turnaround time at this busy tax season. And we just wanted to let everyone know this is a continual work in progress, and we would anticipate it to remain as such for some time. Now, throughout the rest of the presentation, Raina and I have taken a format where we're walking you through most of the lines of the IT SBD form. We're speaking to the line item itself, and then we've interjected some either scenarios or some questions that we've already received about that particular line item. So hopefully this will be helpful in this format for you. So if I kick it off with the line 1 from the IT SBD, and this is pretty much how it reads, you know, self-employment income, whether it's federal Schedule C, CEZ, F, guaranteed payments and or compensation received from each pass-through entity in which you have at least a 20% direct or indirect ownership interest. And we've underlined that 20% and direct and indirect because the next few slides will speak to each one of those areas. And keep in mind that when you're looking at that 20% compensation piece, you're adding back, or you're putting on line 1 the entire portion of your distributive share of that compensation. And we've got some examples coming forward on that. So in this example, we're looking at a pass-through entity compensation to a 20% or more shareholder. So here we've got taxpayer A, which is an S-Corp, and that S-Corp has $600,000 of net income. That S-Corp is paying wages to John, of $100,000, and John is a 25% owner. It's also paying wages of $60,000 to Mary, who is a 15% owner. The taxpayer, the S-Corp, also is contributing $15,000 for each one of the 3 employees to a simple plan for the employees. So the way that would look on both John and Mary's, we're going to walk you through both of their IT SBDs. So John would report the $100,000 of compensation, the full amount of compensation that he was paid on line 1. We also said that the S-Corp had a net income of $600,000, and if we look at his 25% distributive share of that, he's going to report on line 3 his distributive share, which is $150,000. We're going to total that down to line 7, and then when we look at line 9A, well, first, if we speak to his IRA contribution, we said that he made a $5,000 individual IRA contribution. That was not a business deduction. That was his individual IRA, so you're not going to find that anywhere on the ITSBD. That would not be a part of it. He does, however, include his distributive share of the S-Corp's total simple IRA contribution. If you recall, they made $15,000 simple contribution for 3 employees, so that would have been a total of $45,000, and then John's distributive share is 25% of that, and so you see that here reflected on line 9A. We're going to say, for simplicity's sake, that all of John's business income is sourced to Ohio. So when we look at that, we say his net business income is the $238,000 here, and we're going to use the apportionment factor of 1 since it's all sourced to Ohio. But as you can see, when we get down here to lines 13 or 14, while his total small business investor income is the $238,750, remember I said when we kicked this off that it is limited to 50% of the taxpayer's Ohio adjusted gross income. And we're telling you here that his Ohio adjusted gross income is $225,000. So in this case, he would be eligible for 50% of his OAGI rather than 50% of his small business investor income. So his small business investor deduction is going to be $112,500, and that is the amount that would be carried over to Schedule A. For Mary, Mary is a little bit different. Mary only owns 50% of this, so her compensation of $60,000 you will not find on line 1. She does have the same distributive share of $90,000, so we're taking the 15% of the $600,000 net income. She would report on line 3 her distributive share of the S-Corp income, which is the $90,000. She also is going to take her distributive share of the $45,000 of simple contributions, and again, 15% of that is the $6,000 here. Her net business income then is the $83,250. Her, again, we're going to say all of her business income is sourced to Ohio, and her maximum income that's subject is the $83,250, and as you can see, that is not greater than her OAGI, so she's going to take 50% of line 13, which is the $625, and that's going to carry over to Schedule A. And at this point, I'm going to turn it over to Raina to pick up for the next several slides.
Great, thanks so much, Debbie. So just to recap what Debbie had stated regarding the 20% compensation. So with regard to the investor who is receiving the compensation, when it is a 20% line 1 item, you do want to include that person's the entire amount of compensation that that person received, and not just their distributive share of that amount. So moving on to our next slide, which kind of, oh my goodness, my computer shut down here. Okay, got it. Debbie, if you can go to the previous slide for me. Okay, so what is intended by the terms direct and indirect? If you recall earlier, we talked about what that provision states, and it does say that the investor has to be at least a 20% direct or indirect owner of the business entity. And so we've received this question several times: what is meant by direct and indirect with respect to that rule? So we have a code section up here, 573340A7. That provision does not explicitly define what direct or indirect means. But we can tell you how most people have historically viewed these terms to refer to. And an example situation is where, for example, the investor owns an interest in another pass-through entity that owns the pass-through entity paying the compensation. And I know that's kind of hard to understand. So on the next slide, Debbie and I have an example that hopefully will help clarify what that means. You can see here that James is a 10% investor of S Corp B. I'm sorry, he's a 15% investor of S Corp B, and S Corp B actually owns 90% of the partnership, paying him the compensation of $60,000. So you can see he has $60,000 in wages from Partnership A. James also directly owns 10% of Partnership A. And so when you combine his ownership amounts, he directly and indirectly owns a total of 23.5%. And that's 10% of the Partnership A that we discussed earlier, plus 15% times the 90% of S Corp B that he owns of Partnership A. So you get a total amount of 23.5%. So since that meets the 20% ownership requirement, he both directly and indirectly does meet the provision. Moving on to the next slide. So here we have a question that we've received several times regarding statutory employees. Taxpayer is a statutory employee for federal purposes receiving a Form W-2 from an LLC that he does not own. He reports his W-2 income on Federal Schedule C, but does not file a Schedule SE, a self-employment tax form. Does this taxpayer qualify for the small business deduction? Now, the answer to this question is that if the taxpayer is a statutory employee and that person is not paying self-employment tax, his income is considered to be compensation regardless of whether it is reported on Schedule C or not. And in our statute, it does say that compensation is not business income and therefore does not qualify for the small business deduction. So in this example, this employee is not an owner of the business, but is in fact a statutory employee, and his income, his compensation from this business is not going to be business income and is not included on the small business deduction form. Our next question. The taxpayer has a non-compete agreement related to an S corporation for which he receives payments. All right, given that the agreement is connected to the business of the S corporation, would this qualify as business income eligible for the small business deduction? And our response to this was that they're likely not considered to be business income, and that is 100% true if these following terms are met. If the taxpayer is not in the business of signing and fulfilling the terms of non-competes, which is sort of a silly way to put it, but really the taxpayer is not engaging in this type of activity frequently or regularly to generate income, and nor is it an integral part to that taxpayer's business. So in this case, this income from these type of agreements would not be considered business income. Moving on to slide 16. So now we move on to SBD Line 2. Line 2 of the form accommodates the add back for related member expenses or related member payments by a pass-through entity. And we do have the code section up there for your reference. Related member is defined also in the code, and it actually references 3 provisions that might give you a little bit more indication as to what a related member is. And it's very complicated. But just to kind of pare it down, one of the sections references family attribution. It uses a 50% ownership amount. Another section, IRC 1563B, is referenced, which discusses component members. And IRC 1563E is also mentioned, which references entity attribution. But in fact, it replaces the 5% requirement with a 40% ownership requirement. So those are some details with regard to that definition. And in the next slides, we're going to provide some additional information and illustrate some examples. All right, so we're still talking about line 2 here. In line 2 must be a positive amount or 0, and it only includes, it only includes your distributive share of the expense. So the taxpayer who's filing this ITSBD form can only include their distributive share of the total expense that is paid by the entity. Amounts that are already shown or accounted for on line 1 should not be included on this line. And keep in mind that you don't want to add back expenses which are a result of certain sales of inventory. And the statute kind of gives a little bit more information about what those are, and also our instructions. Keep in mind that if you do enter an amount on this line that is not already included in your Ohio Adjusted Gross Income, you will have to report that on your Ohio IT 1040 Schedule A, line 34, as a pass-through entity adjustment. And our instructions also give some information on that. All right, now these are some examples of common related member adjustments, and they can include management fees, interest expenses. We have rent and royalty expenses these are some intangible expenses, wages paid to certain family members, expense sharing arrangements, and some other expenses. And we do have the wages paid to family members there. We know that in some cases there may be kind of an overlap between the 20% compensation and the related member add back in a fact pattern. So we will have some examples of those coming up. On the next slide here. Do family attribution rules apply when determining if a person or entity is a related member? And earlier in the related entity definition that I had provided, I did cite that there is family attribution that applies in certain cases. And I included here a portion of the statute that does use that reference to the attribution rules in Section 318 of the IRC. So if you have an individual stockholder or a member of that stockholder's family under the family member relationships that are provided in 318, if that stockholder and the members of that stockholder's family own in the aggregate at least 50% of the value of the taxpayer's outstanding stock, then that stockholder is considered a related member. Moving on to the next slide. Here's an example. An S corporation pays rents to a partnership. The S corporation is owned by a husband and a wife. Does this rent get added back on line 2 of the ITSBD? So basically the answer to this question really depends on what is the ownership of the partnership. And so here we say if the husband and wife both also are the sole shareholders of the partnership and all the requirements of our related member section are met, then the rent must be included on line 2 of the ITSBD. So the answer is yes. Our next slide here. So from the previous example, we also got some questions regarding including business income twice. So the question here is, wouldn't husband and wife also have a separate worksheet for the partnership where the net rental income is included on line 4? If so, it seems the rent income is being included as business income twice. Is this correct? So the answer to this question is yes, if the income is also considered to be business income to the partnership. So it really depends on whether the partnership is also in the business of collecting rental income, and renting out its property. However, you do have to keep in mind that this is going to be mitigated by the fact that the pass-through entity adjustment has to be made. As you recall earlier, we talked about how you have to put that on line 34 of your IT 1040 so that it is included in your OAGI. And also, in our third point here, we talk about the term unitary, which is mentioned in our ITSBD instructions. If your businesses are so integrated that they should be viewed as a unitary business, for example, they share some economies of scale, they have centralized management, or they have several other transactions between them, you might want to consider whether or not you want to file one ITSBD form to reflect that those entities should be filing on a combined basis. Now keep in mind, this is not really, its combination is not expressly allowed or disallowed by the statute, so it's not expressly in the statute, but we do have that terminology in our instructions. All right, and now moving on to some related member adjustment examples. And hopefully these will help you see what we're talking about here in a visual sense. Here we see Investor 3 owning 50% of taxpayer S Corp A and 70% of LLPB, which is receiving $20,000 of rent from the taxpayer. And if you take a look, investors 1, 2, and 3, those are all going to be entitled to add back their distributive shares of the rent on ITSBD Line 2, because we do in fact here have a related member rent expense. And kind of the point of this example is to show that taxpayer S Corp A and LLPB really have substantially the same amount of ownership and the same owners who substantially own both of them. So that's really what the related member statute is intended to do, to add back an expense that can, in theory, be viewed as an expense being paid to oneself. And on the next slide, we have another example of a salary expense paid to the family member of the shareholder. If you take a look here, Investor 2, the husband owns 60% of taxpayer A, the S corporation, and Investor 2's spouse is going to receive a $50,000 wage from the taxpayer. So in this case, investors 1 and 2 would be entitled to add back their distributed shares of the salary on ITSBD Line 2. So, for example, Investor 2 is going to take 60% of the $50,000 and include that on Line 2 of their ITSBD.
Okay, thank you, Raina. Pick up and talk just a little bit more about related members and the 20% compensation piece. So we've got an example here where a family owns 100% of an Ohio-based S Corp, and that S Corp has net income of $1 million. Again, for simplicity's sake, we're going to assume that all income is apportioned to Ohio for this small business deduction. What you see below is the ownership percentage, their distributive share, and the compensation that they received from the S Corp. So we've got father and mother at 26% ownership. They have a distributive share of the net income of $260,000 and wages of $40,000. The son 34%, $340,000, $700,000, and the daughter is the only one that owns less than 20%, but she also does have compensation of $15,000. So if we work that through, first we'll talk about, how is this daughter a related member, so that we're talking about what needs to happen with her income and her compensation. Well, she is a related member because, as Raina said, one of the key components is that she is a stockholder, and through either direct or indirect, her father and mother, they own at least 50%. We've got 26% for the father, the same for the mother, and 14% for her. So in aggregate, they own 66%, so she is going to be considered a related member. So when we look at what that means on the filing of the ITSBD, what we have here in a different format, but this is line 1, 2, and 3 of the ITSBD for each of the 4 related members in this S Corp. So line 1, firstly, if we just do a quick recap, we can see the percentages here of their ownership, their distributive percentages for the S Corp. So we see that 3 of the individuals have a greater than 20% ownership, so each of them must again include their entire amount of their compensation. And so we said father and mother each had $40,000, the son had $70,000. Since the daughter owns less than 20%, she's not putting her $15,000 of compensation on line 1. If we look at line 2, again, the daughter is a related member. We established that she and her parents together own more than 50%. So each shareholder, all 4 of them, each one of the 4, must report a related member add back for his or her distributive share of the $15,000 that was the daughter's compensation. So if we take that $15,000 that was her compensation and we multiply that times the father's distributive share of 26%, he's going to have a related member add back on line 2 of $3,900. And the same would apply all the way across, including 14% of that $15,000 compensation also is the related member add back for the daughter. So all 4 members have something on line 2, their distributive share of that add back. Line 3, basically the intent of this is the same for everybody. This is each shareholder including their entire amount of their distributive share of the S-Corp's income. And we said the S-Corp had $1 million in income, so 26% of that for the father is here. So this is what we have. So that's what lines 1, 2, and 3 would look like. Now the thing that we want to also note is that the father, the mother, and the son, they will each have a line 34 add back on their 1040 that would be the equivalent of their line 2 on their ITSBD. The daughter does not have that add back because her compensation was already included in her federal AGI. So moving on to line 3 of the SBD. This is the ordinary or income or loss from the trade or business activities, again, to the extent that you've not already included this income on line 1. And here on line 3, you're reporting your distributive or proportionate share of income that's included in your federal AGI regardless of your ownership. So as we said, even with the daughter in our prior example, even though she was only a 14% owner, the distributive or proportionate share of the income from that S-Corp in her case was included on line 3. You can see some of these income amounts you could find from your federal Schedule K-1 and also from the federal 1040 line 17 if it's a Schedule E income. Line 4. This is going to be your net income or loss from your rental activities or royalties, interest income and dividend income. And again, we give you a reference here of Schedule E line 17 as long as this is business income. We've taken a position that rental income should be included as business income if it's received on a regular and consistent basis. For example, monthly, if you've got a rental property and the income is coming in on a monthly basis. Most federal Schedule E income is included in federal AGI, whether it's passive or non-passive, and then therefore would be eligible for the small business deduction. One of the things that people have asked us about quite often is the interest and dividend portion of this line. You know, can I include that on here? And if it is to the extent that it's generated in the ordinary course of your business. So, you know, we've come to use the phrase, if it's in the business of doing such activity, then, you know, in the business of investing assets, then that income would be subject. It's because the primary business is investing, so their purpose is generating interest and dividends. However, interest and dividends that are just incidental to your primary business operation is not considered business income and therefore would not be included on line 4 of ITSBD. So we have a couple of examples and questions around this that we received. This one talks about a taxpayer who personally owns 5 rental properties. In this scenario, we're not really talking about somebody who has formed a partnership on this. This could just be your individual who owns a few rental properties. In this case, 5 properties, 4 which are located in Ohio and 1 that is in Florida. This taxpayer does not report on federal 1040 Schedule C, but he reports it as passive income on Schedule E. The 4 Ohio rentals have a net profit while the Florida property has a loss. So the question here is, does this loss offset the net profit from the other Ohio properties? So again, we say if all the rental income is business income, the taxpayer should include the amount on ITSBD as rental income. This should mirror their figure that they have on line 17 on their 1040. Could be a net amount if there were passive losses allowed. And then lastly, you're going to take care of the Florida piece versus the Ohio piece when you're doing Part 2 of the ITSBD, which is the apportionment formula. So that's where you'll look at what part of the Ohio and what part of the Florida is actually calculated in when you do your apportionment. Here we have one where we have a taxpayer that owns 100% of an S-Corp, and in 2013 the taxpayer received dividends that were paid out of the accumulated earnings and profit due to the conversion from a C-Corp status. So while it is an S-Corp now, the earnings were accumulated when this entity was a C-Corp. So these dividends are included in federal AGI. Would these dividends qualify for the line 4 on the SBD? And the answer here is no, because this income retains its character when it was a C Corp. So these dividend distributions are still as if they were coming from a C Corp, and they're treated as ordinary income. So then it is not, this income is not considered to be a distributive share. Moving on to line 5 of ITSBD. This is your net capital gains or losses, and this again is to the extent that it is business income. And we cite the case here of Kemple versus Zano and the code section. Again, gain and losses reported on this line must be those which are generated in the ordinary course of business or from assets, the sale of assets that were an integral part of the taxpayer's business operations. So again, if you're in the business of, or if you sold an asset that was used to generate business income because you were in the business income of doing such activity, the amount on this line could be positive or negative or a 0. So I think we've got a couple of examples on this. So here we have an S-Corp that primarily operates to make and sell bicycles, and it invests the available cash that it had in stocks. The S-Corp later sells these stocks, which results in a capital gain. The capital gain is reported on Tom's K1. Can this gain be included to Tom on line 1? Well, based on our previous conversation, this would be a no, because Tom is in the business of making and selling bicycles. He's not in the business of investing. So the income was not received in the regular course of business, the income from the sale of these stocks. So therefore, he does not qualify for this deduction. Okay, if business property sale is treated, if a business property sale is treated as ordinary income on federal 4797, does this include for the, does this income qualify for the SBD? So again, we would first cite that it must be considered business income under Ohio law, and if the property was an integral part of the taxpayer's operation, then there is a good likely argument that the gain on the sale of the property was business income. Each individual taxpayer preparer would have to take a look at, was that property an integral part of the business, and determine from that perspective. And then an example, we've got a farmer We talked about, is it an integral part of the business? Is that asset? We've got a farmer that sells a tractor used in his wheat farming operation, and it generates, the sale of that tractor generates a capital gain. He obviously couldn't, harvest that wheat by hand. He does need that tractor. So can this be included on line 5? Yes, it was an integral part of harvesting that wheat, and it would be considered business income. The capital gain would be.
All right, I guess it's my turn now, Debbie. So
yes,
now we're getting to ITSBD lines 6 and 9B. These are the fun lines on the ITSBD form where depreciation is reported. So we have, we're talking here about accelerated depreciation. Enter on this line amounts only if your business took advantage of federal accelerated depreciation amounts. So here we're talking about 168K bonus depreciation and 179 depreciation. The taxpayer, the individual is required to report their distributive or proportionate share of the add-back amounts on line 6, and also distributive and proportionate shares of the deduction amounts on line 9B of the ITSBD. On the next slide, we have an example of this just to kind of help illustrate what kind of situation we're looking at. And Debbie, if you can move that slide forward for me. All right. So on IT 1040, lines 35G and 37B, the question is, adjustments are reported for IRC 168K and 179 depreciation expenses. Question is, do I enter the same amounts on the ITSBD worksheet? And our answer here is that on the ITSBD form, you only want to enter amounts concerning the business for which that ITSBD is being filed. And these lines should only reflect the individual's proportionate or distributive shares of the depreciation for assets that are used by that particular business. So if the taxpayer only has one business, and that is the business that owns and uses the assets that we're talking about here, then yes, the numbers should be the same as those that are reported on your Schedule A of your IT 1040. And if you want to take a look at some more information about this, we do have a code section site there that you can reference. On the next page, we kind of give you a more detailed breakdown of how this would work out on the form. In this example, John owns 25% of S Corp A. In 2013, S Corp A has $50,000 of excess 179 depreciation. If you recall, the statute actually requires you to look at excess depreciation over the amount of depreciation from 2002 that was $25,000, and so in this case, that would be $50,000 that S Corp A has depreciation amount, and then $50,000 of Section 168K bonus depreciation. And the facts say that this is John's only business. So S Corp A is going to be required to add back 5/6 of these depreciation amounts, or $83,333, and John has to basically include his proportionate share of this total amount, which is 25%, on his line 35G of the IT 1040 and line 6 of the ITSBD. For the following 5 years, John will be entitled to a deduction of 1/5 of the amount he added back in 2013. So you take 1/5 and of his add back amount, so you get $4,167. This deduction should be entered on line 37B of the Ohio IT 1040 and line 9B of the ITSBD. So hopefully that clarifies kind of how you will treat these amounts on your ITSBD form. Moving on to line 7 of the form. This line is going to include other items of income and gains separately stated on your Federal Schedule K-1 and miscellaneous federal income tax adjustments if there are any. When we talk about miscellaneous federal income tax adjustments, in many cases those will have to do with issues with conformity, with Ohio conforming to federal law after some federal laws have changed, and those type of issues. At this point, Ohio is fully conformed to federal provisions that that we don't expressly have we haven't expressly decoupled from when you read in our statute. So at this point, we're fully conformed. So not many people are going to be using that line for miscellaneous federal income tax adjustments. Other items of income and gain that are generated in the ordinary course of the taxpayer's businesses, which are not applicable to lines 1 through 5, can also be included on this line. And if you need some examples of those, we have a general line title, I guess you could say, for that line, because there are several separately stated items that could exist that could be business income and deductions. So if you take a look at Federal K-1 instructions, you'll be able to find some examples, of those deductions that could be separately stated. Income and deductions. So next we see here line 9A. Here on this line you want to report the taxpayer's federal 1040 above the line business deductions. These include deductions for the following: the KEO, the simple IRA, the simplified employee pension plans, self-employment taxes that are paid, self-employment health insurance that is paid. So all these items that are on your federal 1040 would be going on line 9A if they are affiliated and associated with your business. Moving on to line 10. So on this line you want to report net business income. So you're going to take the total business income from the top of the form, Part 1A, and take the total business deductions from Part B of the form, and you're going to net those, and you're going to come up with a number for line 10. That's your net business income. A question that we often receive is, if you have a loss in that scenario, should a loss from a business be reported on this line? And the answer to that question is no. If a taxpayer owns just one business entity and line 10 amounts to 0 or a negative number, the individual is not going to have a small business deduction. So and a lot of times, I tell people, do you really want to have a negative deduction? I don't think you do. And the way that the statute reads, that certainly is not intended. So you don't have a small business deduction if you have a negative number on line 10. Moving on to line 13. So line 13 is Ohio Small Business Investor Income. That's your total Ohio Small Business Investor Income. And so what you have to do, if the taxpayers have completed multiple schedules, for example, if you have multiple entities that are generating business income, they should net line 12 from each ITSBD form and enter the total for all the schedules on this line. So the title of line 12 on the form is Total Business Income. I'm sorry, line 13 is Ohio Small Business Investor Income, and it says on there line 12 from each separate schedule. Okay, so that's what you want to go ahead and do there, is just net all of those. If the amount on this line after netting is 0 or a negative figure, again, the individual would not have any small business deduction. If you're filing a joint return with your spouse, all business income for a husband and wife from one entity must be combined on one ITSBD form. So if the husband and wife own the same business and that's the only business they have, then you want to combine those amounts and put those on one form. If joint filers have income from separate entities, the husband and wife will have to separate those out and file separate ITSBD forms for each entity. Line 12 is then going to have to be netted from each of those entities, as we stated before, in order to determine the amount for line 13. All right, so line 14 has generated some questions as well, and hopefully this will help explain what we mean with regard to the limitations. So here, this line says maximum Ohio small business investor income subject to deduction. So in the beginning of our presentation, we talked about how the statute caps the deduction at $250,000. It caps Ohio small business investor income at $250,000 for married filing jointly filers, single filers, or head of household filers. All other filers, including those who are married filing separately, the maximum amount of the income subject to deduction is going to be $125,000. Though the thing that you have to keep in mind is that the amount on this line can never exceed the amount of your Ohio adjusted gross income as if it were calculated prior to taking the deduction that we're talking about here. So the way that the statute reads requires this deduction, this income that is subject to the deduction to never exceed your OAGI. And that certainly would make sense since it has to be a portion of your OAGI. All right, and moving on to slide 43. All right, so on slide 43 here, we're talking about Part 2. And this is where you determine your apportionment ratio for Part 1C. And Part 2 contains the apportionment formula. So the question that we get a lot is, what really is apportionment? So apportionment is merely a mechanism by which the state of Ohio determines what portion of your business income is Ohio sourced. And we have a code section up there. Under that provision, all items of business income and deduction are apportioned to Ohio by using a 3-factor weighted apportionment ratio. So if you can see in that chart there, the apportionment ratio, the weighted ratio, is calculated by taking the business's property, payroll, and sales amounts and then weighting them. And then when you take those weighted amounts, you add them up and you get a weighted ratio. You take that total ratio and what you'll have to do is multiply that times the business's total apportionable base to get the amount of income that is sourced to Ohio. So the thing you want to note about when you do this formula here, when you go through it, if your business does not have property or payroll in Ohio or everywhere, so if you're in a situation where your business only has, let's say, payroll and sales only and no property, or it has property and sales but no payroll, the weight that's going to be given to the other factors in that scenario has to be proportionately increased so that the total weight that's given to the combined factors is 100%. So let's say you have sales and you have payroll but you don't have property. What you'll have to do is weight the sales amount, the sales ratio at 75% and weight the payroll amount at 25%. And those add up to 100% there. If you need more information on that, you can also see the explanation in our instructions, which will help you out there, and let us know if you have questions about it. Moving on to slide 44. So here we've gotten a lot of questions on apportionment, and here we provided an example regarding a business that provides consulting services. So a consulting firm located in Ohio provides services to clients who live in Ohio and in other states. Will the sales from services provided to clients outside of Ohio be included as within Ohio sales or total everywhere sales for Ohio apportionment purposes? So here you want to reference our statute that discusses how you cite a sales. And 5733.05 B2C2, I believe, is where you want to look for this. Ohio uses a market approach to citing sales that are generated from a business that provides services. So anytime you have sales generated from services provided, what you want to do is look at the location where the benefit is received by the purchaser. And if the firm in this case provided services to clients that are physically located outside Ohio, those are going to be considered non-Ohio sales because the physical location of where the purchaser is receiving the benefit is going to be paramount here. So these are non-Ohio sales. That means they shouldn't be included. They should not be included as within Ohio sales. So they should not be included in column 1 of the apportionment schedule that we looked at earlier. They should be included within the total everywhere sales number, of course, because that is going to be the total number of the business's sales. If you need more information about this, you can take a look at page 5 and 6 of the instructions in the ITSBD instructions, and that may give you some more information. And I will turn it over to Debbie for the next couple slides.
Yeah, we just have a couple of slides left, and then I think we'll be able to open it up and try to respond to some of the numerous questions that I've seen come in so far. when the small business investor deduction was introduced, they wanted to make sure that it did not impact the revenue that goes out to the local school districts. So, you know, what needed to be done to take care of that? So, in fact, it does not impact the school district revenue. So what was required by that is an add back on traditional school districts. So if you took the small business investor deduction on Schedule A of the 1040 and you live in a traditional school district, you will have an add back on that school district return. And it is line 18, as you can see here. One of the new things this year is that we actually have two schedules on the individual school district return. We have both a Schedule A and a Schedule B, and for the last several years we've had just a Schedule B. So Schedule A this year is for the traditional, and because they are starting with their Ohio adjusted gross income basically on line 17, that is a number that has already been reduced by the 50% small business investor deduction. So we need to add that back on line 18 so that when you're looking at your taxable income for that school district, you make sure you have that income included back in there. With the earned income districts, they don't start with Ohio adjusted gross income. They have a different method in working it through here on their schedule, so no add back is actually necessary for the earned income districts. Now here's a slide that has most of my contact information as well as Raina's. So I think I'll leave this up for the duration of us trying to work with our questions. And as Raina and I sort through the technology piece of this just a moment, we're going to try to make it so that we can expand the area and see the questions better. Which I've been successful in that. Have you, Raina?
I've been trying to be.
I do a lot more webinars than Raina, so she's still working out the technical aspect of everything. Let me see while you're working on that, Raina. I'm not going to go in any particular order that I see the questions, and forgive me, they are, here's an easy one. This one says, will CPEs be available? And unfortunately on this particular webinar they are not. We have worked in the future to make some of that happen. We actually did that on our Ohio Virtual Tax Academy a couple of weeks ago. There's a few extra steps and processes with, I think it was the Department of Education. I wasn't personally involved in that, making that happen. I know it's an option, so we'll certainly consider that for the future and see what we can do in that arena. Let's see.
All right. Let's see.
Are you seeing them too now, Raina?
I am seeing them.
I'm trying to decide what would be our best approach, if we want to start at the top and just kind of pick and choose through ones that we think we can totally understand what's being asked. In some cases, we have to get back with people and ask for more detail. Okay.
Well, I do see a question here regarding partnerships. This person asked, if a partner lends money to a partnership, is the interest income eligible for the small business deduction? That's a good question. I think we've had some similar examples in our presentation today. But if the interest income is paid to a related member, so if the partnership that is being that is receiving the income is a related member to the partnership paying it, then possibly yes, that would be eligible for the small business deduction. It would have to be included on line 2 as an add back for expenses paid to related members. So that, there's that. I keep looking through some of these questions, Debbie.
Okay, and why don't we just to try to help ourselves, Raina, we'll maybe try to ping pong back and forth. So I'll take one now. Again, maybe I'm picking the easy ones, Raina. This one's definitely easy because I'm passing it off. This one says,
oh, thank you, Debbie, so much. I really appreciate that.
But actually not to you. This one says, I have multiple questions that may best be asked after the webinar and most relate to pass-through entity. So who would be a contact person? And this is from Dreama. So Dreama, if you could take my email here and send me an email, I would most likely pass that off to Mark Berkey. I unfortunately don't have his phone number in front of me, and as I'm the presenter with my screen up, I can't get to that information right now. But Mark Berkey would be the contact, and so just send me a quick email and I'll respond with his information. And again, I see several on here, Raina, again, where they're talking about getting the PowerPoint. And for anybody who maybe wasn't at the beginning, I'll just say again real quickly, we will have this entire recorded PowerPoint as well as just a PDF version of the PowerPoint. We'll post that to 2 different locations on our website by the middle of next week. One will be under the Small Business Investor Deduction area right from our homepage. There is a link to that. And the second spot would be on our Ohio Virtual Tax Academy webpage. Again, both can be found through tax.ohio.gov.
Thanks, Debbie. All right, so I'm taking a look at some more questions here. We have a question from, let's see here, an asker. Are separately stated items such as Section 1231 gain or loss? So this person is asking whether that is a separately stated item. The answer to that is yes. Section 1231 gain is definitely going to be a separately stated item and accounted for at the individual level. So that is, yes, that is one item that we are talking about when we're referring to, let's see here, what line item would that go on? That's going to be possibly on line 5 of the ITSBD. So if you're talking about a gain or loss from an asset that was used in a business operation and that is business income, then you will include that on line 5 of your ITSBD.
Okay, thanks, Raina. I've got another one. I hope I'm interpreting. This is from Doug, and he says, i.e., a loss of $10,000, a gain of $15,000. What is my line 12? So again, this is your total business income apportioned to Ohio. So if I'm assuming that this is 100% apportioned to Ohio, I don't have a factor here, then, oh, this is a tricky thing. When some new question comes in, my question just moved on me.
Yeah.
But if we have a $10,000 loss, and I believe it was a $15,000 gain, and we've got 2 different entities, and you've done 2 different line 12s, you're going to have a $5,000 positive amount on line 13 that would be subject to the 50% deduction.
I got one here, Debbie. So I think this one might be interesting for people to hear. Question is, I believe PTE considers income from a non-compete agreement as business income. Why would the income be considered business income for the PTE but not for the small business deduction? So I think the distinction that you really need to look at in a non-compete arrangement is who is receiving the income from this arrangement and who is paying it, and also who exactly is the taxpayer that's filing the ITSBD form. So and in a case where you have a pass-through entity that signed a non-compete agreement with an individual, let's say, and the pass-through entity is, when it pays that amount to the individual, is reporting that as an expense, and the individual is reporting that as income. The distinction that we're making is that the individual, him or herself, if they're not in the business of entering into non-compete agreements and generating income from that as their own primary business operation, that would not be typically considered business income to that individual. So keep that in mind, that when you have the individual getting the payment, it typically is not going to be the case. I'm not sure, Debbie, have you ever seen a situation where a taxpayer was in the business of signing non-compete agreements? I'm not sure if people actually enter into a business for profit to conduct that type of activity, but I'm sure it certainly can be possible. Let's see if we can find some other questions here.
Well, I'm trying to see technology-wise, and this is one of our first endeavors like this, and I was trying to see if there's a way for you and I, Raina, to tell the questions that Vaughn has already been able to answer.
Okay.
Because I know that a couple of questions that we answered, he has already been able to answer.
Great.
So, yeah, I'm just trying to sort this out as we kind of learn together on this. I don't see it in my answer field. So I apologize ahead of time if some of you realize that's what's happening. So we're trying to, you know, get responses to you without repeating ourselves. Okay.
I do see another question here, Debbie, that we might want to talk about.
Okay.
Let's see here. So the question is, would the compensation from the pass-through entity include 401k contributions, the employee's contribution and the employer's? So my gut feel would be that, you know, the pass-through entity is really making this contribution directly to the 401k plan. And my understanding is that's typically excluded from your line 1 W-2 number, and so that probably wouldn't be considered compensation. Debbie, is that your thought on that?
It is, yes.
Okay. So it looks like it wouldn't be. It is an expense to the business. Let's see here, the employee's contribution and the employer's. I'm not sure what the question is getting to, but possibly whether or not this amount would be for a 20% or more owner of that entity. You know, could you include the portion of the contribution within the small business deduction? And my gut feel would be that it's not included in there. When you're talking about compensation, you only want to look to what amount of compensation is included in your FAGI. In line 1 on your federal return is only going to include line 1 from your W-2 form. I hope I got that right, Debbie.
Okay. I've got one. If a partnership sells business property on an installment sale, is the interest income eligible for SBD? I want to say that we have this as an FAQ on our website, but there have been so many questions about this. I mean, I think we're rolling close to the hundreds and hundreds that we've responded to. But in that case, if a partnership sells business property on an installment sale, is the interest income eligible for the SBD? So again, this is going to relate to back to, are you in the business of doing that? Let's see. Partnership sells business property on an installment sale. Yeah, so I would say generally just because you are selling a piece of business property that interest income would not be eligible. What would you think about that, Raina?
And I would say that you're correct, unless that business property was an integral part of your business operation. So
right.
If you're talking about the sale by that farmer that we discussed earlier of a tractor, and that tractor was really, really very important to him being able to conduct his farming operation, and then you went ahead and sold that on an installment sale, you probably have a good argument that the interest income is going to be business income.
And I would agree. Yeah.
Okay. Great. Let's see here, and I have another question here about the 20% owners and the compensation. You indicated in a previous webinar that spouses of more than 20% owners could deduct wages as a business deduction. Not sure what that means. What about other family members owning 20% or more through attribution? Well, you know, I think we had an example in some of our slides here where you had a situation where kind of the related member concept and the 20% compensation concept were kind of intermixed. You had those both existing in the same situation. And this typically comes up in the situation where you have a closely held family business and you have some owners, you have all the owners are related, and some of them are 20% and some of them are not. So what you want to do is look for, first of all, you know, which issue is the amount of income subject to? Is it subject to the related member add back, or is it subject to the 20% compensation recharacterization? And in a situation where you have a less than 20% owner, you want to determine whether or not that person is a related member, and use line 2 for that. If you have a 20% or more owner, then you want to take a look at it, whether or not you can put that on line 1. When you look at the 20% ownership one, 20% ownership provision, it doesn't expressly mention family attribution. It just says an indirect or direct ownership interest, as we talked about before. And you know, as you also saw in some of our other slides, in the related member definition, there are a lot of references to attribution rules there. So where it's not expressly included in the statute, you probably don't want to use family attribution. So in the 20% indirect or direct, you know, our recommendation is not to use that, though we have mostly seen the interpretation of that provision referring to what our example provided in that slide that we showed you, with that person owning both indirectly and directly a business, 23.5% of that business that we showed you. So we think that's really what indirect and direct means. Now, I know that some people will attempt to take positions otherwise, but that is not expressly included in the statute. We see another question here, Debbie, that looks good.
Well, yeah, I've got one. If I'm understanding the question correctly, I'm reading it as, if we net line 13, which is the Ohio Small Business Investor Income, if we net line 13, can we choose only positive entities if we have multiple entities? If I'm understanding the question, the answer would be no. I mean, if you have filled out, let's say you're a part of 3 different entities and you have completed 3 IT SBDs down through line 12, and you say that 2 of those have positive income and 1 has negative, you may not choose to go on down to line 13 and only include the positive incomes to end up having a larger amount to take 50% of. You would need to go ahead and net in that 3rd one, which was a loss. Okay.
Very good. I do see another question about apportionment.
Okay.
And Debbie, there's a question here. Somebody is saying that my voice is echoing pretty loudly. I'm not sure if that's the case for you as well.
It is not for me. I saw that earlier. I don't know if it is from, you know, a lot of other people out there, but not internally.
Okay, great. All right, so I do see a question here about apportionment. How is income received from a large partnership apportioned? And this person is asking, for example, a partner in a law firm receives a K-1 from the law firm for his work in Ohio. The income is business income, and it's for his work to Ohio. He can't be expected to apportion it based on the law firm's factors, can he? And so that's the question. And we've had this question a couple times before as well. Basically, people are asking whether or not, you know, if you know that all your sales and all your payroll and property are all within Ohio, can you just include a total weighted ratio of just 1.0, 100%, to use on that form? Do you really have to go through and include separate, you know, numbers for your property, payroll, and sales? And the answer to this question is, you know, in a sense, you do really want to fill out a completed form of the ITSBD. So that's definitely what we would recommend is for you guys to go ahead and do that. But keep in mind that if you do choose to just put down a weighted ratio of 1.0 and, you know, you choose not to fill out the rest of that Part 2, keep in mind that it could be viewed as an incomplete return. And also, though, if that is a correct number, if the department does end up auditing your schedule, and that 1.0 amount is correct, you probably won't be subject to any interest or penalties in that sense for any tax amounts, as long as that number is correct. So there are kind of 2 sides to that story, and we certainly would never advise people to fill out an incomplete form, but hopefully that answers your question nonetheless.
Okay, I've got one, Raina, talking about rental property.
Mm-hmm.
This one says, first it says, can you take it on the rental of a building? And just one fact they give us is that the person, I assume this is the taxpayer who's maybe wanting to include this. It says the person is retired from the business, but he still owns the building. So if this retired individual taxpayer is wanting to include this rental income on the ITSBD, we would refer back to, if he's receiving this rental income on a consistent basis, i.e. monthly or, whatever a considered basis is, we would probably say that yes, he would be eligible for that. Would you agree on that, Raina?
I would agree. I would agree on that.
Okay. You can see, Raina and I say, would we agree on this? We actually have big white-on boards in everybody's offices and drawing out these scenarios on more than a daily basis. So I did see someone in here saying, to have patience as we sort through this, because it's certainly, I would say, it is the department's position to try to have as many people eligible for this as possible, obviously interpreting the code as we go. But this is certainly, hopefully, something that is going to be beneficial to just, hundreds of thousands of taxpayers in the state.
Mm-hmm. Let's see here. Okay, and I do have a question here regarding royalties and oil leases.
Oh, okay.
This person is asking, yes, and this person is asking us to talk about some rent, royalties, and oil leases. And he says that I have been told that line 4 applied, line 4, let's see what line 4 says, net income loss from rental activities, net royalties, interest income, and dividend income. This person says, I had been told that line 4 applied to anything on a Schedule E. Now I am questioning this because I have heard nothing about royalties or oil leases. And I think, most of our questions have been about, let's see here, about royalties from the leasing of mineral rights and things like that, and rental activities. And a lot of our questions have stemmed from the fact that at the federal level, these are considered to be passive activities, typically, and they're not viewed as trade or business activities because of that. They're passive activities, and they're included on Part 1 of your Schedule E form at the federal level. But the department is not viewing these as not being trade or business activities. We, in fact, are viewing these as being business income in many cases. And the provision in our statute that defines what business income is, it's worded slightly different than the federal provisions, and that's kind of the position that we are taking. So if you look at line 4, and you do have some royalty income on your Part 1 of your Schedule E, you can include that there as a part of your business income. Let's see here. Sounds like
okay. We've got one, Raina. Oh, excuse me. It says, why do the instructions, and I'm sure they're talking about the ITSBD instructions, why do line 6 instructions say for tax years 2012 and after? Shouldn't it say 2013 and after? And actually the reference there to the 2012, it talks about the depreciation, and it's actually pointing out that in 2012 we had House Bill 365, which gave you the option, based on, certain things that happened within your business during the year with withholding and everything like that, as to whether you would add back 2/3, 5/6, or 6/6. So that 2012 reference is actually to the fractional percentage for the add back.
Let's see here. Getting some questions in here. Include. All right, so someone asked a question here regarding line 2, the add back for the related member. Do you include in line 2 expenses paid directly to yourself or to other related members? And so the answer to this question is that on line 2, you want to include your distributive share of the related member expense, the total related member expense that was made by the taxpayer, by the entity that you own. So you only want to include your distributive share there. And keep in mind, a lot of these issues have existed for several years for non-resident individuals who file the IT 1040 as a non-resident. They have, the non-residents have always been allocating and apportioning their income. So many of these issues are more well known by non-resident investors. So I think, Debbie, a lot of these questions are coming from residents who now have to accommodate kind of our apportionment rules in our in this analysis to calculate their small business deduction.
I would agree, because typically if you're an Ohio resident, you're not looking at apportionment, and now you're looking at it only to the extent of calculating this deduction.
Exactly.
So I have one here. It's a very short question, so I'm going to have to do some assuming. It just says, what about a Roth contribution? So, you know, if we're talking about an individual who has made a Roth contribution, and maybe can that be included on line 9A where we talk about some other retirement type plans? I mean, if that's what's being asked, the answer would be, you know, potentially no, because, you know, that's probably an individual Roth. Again, I'm making an assumption here. And so based on the fact that it not being a business plan and a part of the business income, that would not be something that would be on the ITSBD.
I agree, Debbie, and keep in mind also that you know, when you do contribute money to a Roth IRA, that money is going to be after-tax money. The federal government does not provide you with any deduction for that amount that you contribute, so there would be no associated deduction with that, even on your federal return.
Right.
And certainly a business doesn't typically contribute to a person's Roth IRA, to an individual's Roth IRA. Is that kind of in your experience, Debbie?
It has been.
Okay.
Yeah. Got a quick one here, Raina. Somebody is probably wanting to follow up and read more about this, asking when this statute was passed. So it was a part of House Bill 59, the budget bill, but I know you're probably going to be better with dates than I, Raina. Am I putting you on the spot?
I can try to be. Well,
I tell people was July.
Well, that is correct. Actually, it came into effect July 1st. It was signed by the governor, I believe, on the 30th, right before July 1st. And most of the provisions in the bill came into effect 90 days thereafter. Some of the provisions came into effect immediately. So it just kind of depends on those things. But the language in the bill made the small business deduction be effective for taxable year 2013. So that is going to be effective for this entire year. And for all businesses that have taxable years ending in 2013. So in some cases, some of these businesses who are on a fiscal year basis, who have a fiscal year that begins in 2012 but ends in 2013, would still also be able to take the small business investor deduction. And I'm talking about the investors in those businesses, the individuals. Keep in mind that pass-through entities cannot take this deduction.
Okay, Raina, we've just got just a few short minutes here to, and we certainly have far more questions here than we can get to in this webinar. Probably have time for just a couple more. So if you want to find one, Raina, while I am giving just a little feedback here, just a reminder that I think what we're first going to do is take all of these questions and compare those to, you know, the almost 100 that we're getting ready to post next Friday on the website from the Virtual Tax Academy, because I know some of these, just because we've already answered a lot of those internally, you know, we've been working on a document to get posted to the web. I don't want you know, everyone to have to sort through 200 questions if we can answer them in 100.
Sure.
So we'll take that time and do that. And again, you've got our direct contact information. We're responding to questions daily as well. So let's try to maybe fit in a couple more, Raina.
Okay. Sounds good, Debbie. And I think we have a couple more that we could fit in that are pretty short. This question says, if a husband owns 100% of an S-Corp and a spouse works for the S-Corp, is her compensation added back for the small business investor deduction? And what you have to look at here is distinguishing between the related member add back and the 20% compensation issue. And in this case, the wife does not own any amount of the S corporation. So the 20% issue with respect to her does not apply. But she is, in fact, a related member under our attribution rules, under our related member definition that we talked about earlier, the 50% aggregate ownership. So in that sense, she is going to be a related member. And her compensation amount can be included on her ITSBD form. Let's see here, that's going to be line 2. It's going to be line 2. And depending on whether the husband and wife file a joint return, will determine whether or not they file a combined ITSBD form. She by herself will not be filing an ITSBD form because she's not an owner of that S-Corp. But if she files jointly with her spouse, then the spouse, in fact, will be filing that ITSBD. See any other questions that we could quickly answer?
I think I've got one.
Okay.
I think answer's quick. You tell me if everyone's in the same realm with me.
Right.
This one says, I have an add back on line 35G and a deduction on 37B. So, you know, they're talking about the 168 and the 179. So they've got the add back and the deduction. But they're saying if my net adjustment on line 50, so that is, you know, the net adjustment from all of your Schedule A additions on the Ohio 1040, you know, less all of your Schedule A deductions. So if my net amount on line 50 is positive, do I add this to line 6 of the SBD worksheet or subtract it? And it's really, you're not going down through line 50. Line 6 and on the ITSBD, the line 6 and the line 9B that speak to the depreciation pieces, those are based solely on the depreciation lines in Schedule A, the amounts that you would have had on 35G and 37B. It doesn't factor in all of your other additions and deductions from Schedule A, which are incorporated into that line 50 net amount. So.
Very good. And I have another quick question, Debbie.
Okay.
Will, this person is asking, will 1040 line 21, the other income line, will income on that line be subject, subject to self-employment tax? Will that qualify for the small business deduction? We received this question several times. There was a scenario where a person was a director on a board of directors of several corporations, was receiving 1099 income from those from providing those services, but that individual was not including that amount on a Schedule C because they in fact didn't really have any deductions to report from that income. So they were just reporting it on line 21 of the other income, line 21 of the federal 1040. And however, they were paying self-employment tax on this income, and I think that's the scenario that this person is asking about here. That income would qualify for the small business deduction. It really is sole proprietor income based on the arrangement example that I provided just now. So if you are an independent contractor performing a service or selling some sort of good and you really are a sole proprietor, and you're reporting other income on this line, then this amount, and you're also paying the self-employment tax, this amount would qualify for the small business deduction.
Okay, Raina, I think on that last question you were starting to break up just a little bit on my end, so I hope everyone was able to hear that, but I'm thinking that is our signal that this is coming to a wrap.
Yeah.
They're getting ready to mute you, whether you want to be muted or not. So
I will be happy with that when I get muted.
We appreciate everyone attending the webinar. Again, we realize there wasn't a lot of notice on this ahead of time, but again, since it's going to be on our website, we hope that there'll be, you know, a lot more people that can benefit from some of this. And we have got a lot of questions here that we did not have time to answer. So look forward to those. I would say we'll use that same 2 locations and put the questions out that we don't get responded that are not the same questions from Virtual Tax Academy. We'll go ahead and place a Word document out there with responses to all these questions as well. And I think we'd probably better serve everyone if we make that a work in progress, so that we're not holding that document here for a week while we get through the 100 questions that we have here. We could probably update that document every couple of days as we get through some of them. So continue to check back to those couple of spots on our website. And again, you've got Raina and I's contact information here. So thank you again, and I think this brings the webinar to a close.